Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, good morning on Friday morning, and we've had an interesting week in the markets.
Bob, we have a question from New Zealand. Laura from Christchurch asks, first, I have some liquidity in sterling at the moment, given Bob's call for a correction in gold as part of the predicted fall crash. I am curious what to do with sterling. With Brexit looming, should I buy gold silver with my sterling now to avoid the risk in the currency, or wait for the correction in precious metals as part of the overall correction and add to my holdings then?
Yeah, gosh. Yeah, our work is mainly on gold in U.S. dollar terms, and where it's done okay, well, actually it was a pretty good rally. It's done very well in other currencies. So if one is looking straight at that, yeah, your sterling portfolio could have some gold in it. We're not in a forward environment where silver would outperform gold. So for insurance, some of the money could be there, but I'd prefer to wait and see the next buying opportunity for the gold shares, which will outperform the metal price. So that's a good one to consider. And thanks very much for the question. Oh, there was another part to the question.
Yes, Laura asked, does Bob still have the Alfa Romeo?
Nice question. No, I sold the last one last year. It was difficult to get it serviced, although it was exceptionally good shape, but the Italian mechanic was just getting wilder and wilder with his temper each year, and it was too distressful. And then it's difficult, even if you leave at 6 a.m. to go for a drive up in the mountain roads. No matter what, by the time you come back, all the bridges have got traffic. And so, unfortunately, the last of the Alfa Romeos went. And thanks for the question, Laura.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines you've dug up for today's show is half the world banks are too weak to survive a serious downturn in the world economy. What kind of a shockwave would that cause?
Well, it's at least the headline came forward that somebody's thinking about it. But yeah, and this is the problem in a business cycle, in a credit cycle, is that everybody gets positive at the same time, gets highly confident that the trend will continue, and in the case of bankers, lend money to increasingly risky situations. And but you have the countermeasures to that, which of course is the theory behind intervention of central banking, and they have this idea that, and we'll talk about the Fed, is there to be lender of last resort. And yes, that's widely and continuously discussed. And you go back to early 1900s, and markets were volatile. They've always been volatile. And certain bankers in New York thought that they'd like to have less risk in their business, and invented the idea of lender of last resort. And they knew then that financial setbacks preceded recessions. So then with the concept of the lender of last resort, they'd be there, the Fed would be there to bail out a specific bank that was in difficulty. And then there'd be no financial setbacks and then no recessions. It makes a lot of sense, doesn't it? But if you take a look at the record, there's been 18 recessions since the Fed opened its doors for business in 1914. So anybody with a science background is going to say, hey, it doesn't work. The theory's no good. And then one may want to look at why the theory doesn't work. And, of course, the issue is that it's not just one bank that becomes reckless in a boom. Many do, and this is what this headline points out, that the authorities, there's always bank regulators and such, are checking it out, and they conclude that large portion of banks can't take a setback. So it's an admission, actually, that the theory doesn't work. So we see things slowing down. You've had fabulous speculation, not just in stocks. Of course, in a great bubble, the stock market commands most of the attention, but you have underneath it terrific speculation going on in the credit markets, which does things to the yield curve and does things to the credit spreads. Every time you get the positive action, and now the credit markets have been turning to, well, less positive and maybe even sometime soon negative. So thanks for the question.
Bob, does this mean we could see banks doing bail-ins where they dip into your bank account to balance their books like they did in Cyprus?
Desperate bankers are always dangerous. And it's classic. You've got the same examples of over-leverage in the mortgage market in Rome 2,000 years ago. And then you have the same over-leveraged with very thorough details in Florence, the financial city-states in northern Italy in 1300s, where an Italian economist wrote the history of the disaster in 1346, 1347, where mortgages was a very popular way to invest. And then everybody got overinvested and rates had come too low and money too easy, and then it reverses, goes the other way. But Sapola's book is very detailed on a financial disaster in 1346 before the plague had arrived. That was 1347, 1348. So it was a natural financial disaster. And when I read it, I made notes, and interestingly enough, the worst parts of that liquidity crisis occurred in the fall of the year. So, and here we are now. We're at the time of year where liquidity problems can be discovered, and this, of course, is what's been happening with the widely publicized news about, first of all, the Fed stepping into the New York money market with repos, which was a way of injecting sort of overnight liquidity into the market. And they ended up doing some huge amounts of that because what happened was the normal liquidity disappeared. And they're still working, now they're shifting over to more aggressive purchasing of bonds out of the market, but they're not going to call it another quantitative easing, or as it was done with capital letters QE. So it's interesting because earlier in the year you had the same liquidity problems in the money markets in Argentina and then Turkey. And that's where our argument was that these distresses, as they appear in the lesser exchanges, eventually hit the senior stock exchanges and financial capital. And for evidence of that, we can all go back 2,000 years ago, where the Roman philosopher writer Cicero pointed out that when there was a money market problem in the eastern provinces, that means the eastern portion of the Mediterranean, it would eventually hit the main money market in Rome, which it did. So, and it continues to this day. So then as the year progressed, we saw that India had a liquidity problem, and then China did. And as I've mentioned, Jim, in July, I guess it was, where the discussion was about China deliberately lowering their currency as a policy measure. And I was sort of going along with that, I guess lazy thinking. And then all of a sudden I thought, oh, no, it is the liquidity crisis hitting. And then I thought, well, lesser exchange, but you can't say that China is a lesser exchange. So had to change the designation to then outlying exchanges, because India and China are so big. And then our guess through the summer was that then it would likely be discovered in New York in the fall, which it is. And for the last few weeks, there's been good news about trade advance deals with China. And at any time, sometimes they'll take whatever's going on in Brexit as good news. So we're in the time when liquidity problems could be discovered. Yes, and it's at the moment a small way in New York. And we're also in a time when one could be looking for weak stock prices. And as I said, these have been potentially there, but not happening, because every once in a while you get a really strong positive news item and they bid the stocks up. So, but we think risks are still there. You've had stock prices at exceptionally high valuations. You've had sentiment numbers that very, very positive, and you had some momentum stuff that is you only find near important cyclical peaks in the stock market. So we're staying with the same view that the financial markets are vulnerable, and the credit markets are slowly turning from positive in July to turning more negative. Now they can get more negative.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline that you saw today: trouble brewing for U.S. companies that gorged on cheap credit. What kind of trouble?
That's the old one, is that when you've got a rising price for whatever game you're in, and bankers are eager to do business, and their business is making loans, so it's called easy money. Like money, credit, borrowing, loans, leverage is all easy. And so companies who are, you got businessmen who are aggressive. You have to be. You've got to have projects and all kinds of things going for you. Otherwise, you wouldn't be in business. And then when you get into a period of easy money, there it is. The money's there to do all kinds of things. Now, not every economic decision is a sound one. And this, of course, is what the market forces are all about, is to select sound business decisions and to condemn unsound ones. And this is where we are now in the transition to where market forces are beginning to judge which is sound business and which isn't. But the saying in English, for hundreds of years has been, when credit is readily available, it's easy money. And that's what in the early 1700s, Dutch, actually late 1600s, Holland, what's now called Holland, was the commercial and financial capital of the world, with Antwerp and then Amsterdam being the money market. And the Dutch have a fabulous description of when credit turns bad. So you have easy credit, and then you have diseased credit markets. And it's a wonderful word usage. And we have had remarkably easy money markets, which can happen whether you have a central bank or not. And then you've got the central banks, which theories and practices I still consider as highly speculative. And they're adding to, in an up market, to the condition that happens anyways, which is easy credit. And then as we watch the credit spreads and the yield curve, which are changing towards adversity, we know that it's going to end up with diseased credit, where there are suddenly no bids for whatever speculative items were around. And you can even go back to the middle 1500s, when Thomas Gresham was not just an outstanding, successful trader, but he was also represented the British Crown into the money market in Antwerp. And then he writes of financial crisis then in the world's money market. And he said, funds cannot be obtained even with double collateral. So the easy money turns to disease credit inevitably, and this is what we're watching. And fortunately, you have these numbers on the spreads and on the yield curve published regularly, and you can monitor it. And all we can say at the moment is these have turned from favorable mid-year to heading towards unfavorable.
Bob, thank you so much for chatting with us.
Well, it was good to be with you, Jim, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.